We've got Mario Singh, co-founder and CEO at FX1 Academy, with us, and of course our guest host, Beat Leonard, Chief Global Strategist at LGT Capital Management. Just as we're hearing more news about sukuks and how some of them are being suspended, because the ones being issued by Nakheel, one of the companies involved in this debt situation, do you think this could really unravel? This could really unravel an emerging market correction, even in Islamic banking, which has been seen as the oasis of sorts in Islamic banking. Yeah, you want to go first?
Well, again, I think the short answer will be no. The investors are not stupid on average. They will definitely be able to separate the wheat from the chaff. I think what reminds us is only that not all emerging markets are good, and not all investment in all emerging markets are always good. So I think the message here is to do your homework, and in this particular case, I guess it would be safer to stay away rather than put in fresh money before we know the whole details.
Beat, do you think there are any more Dubais lingering out there? Any more economies with similar characteristics that could throw up the same problems?
Well, I couldn't name you one. I think it would be very dangerous to call the next candidate, but I think there is actually. There are more candidates around. I believe that's exactly the point. We have a number of emerging markets. I would basically point towards Eastern Europe, where there are a number of cracks in the system, not really addressed at this point in time. The fact is that despite government stimulus, despite global monetary policy easing, quantitative easing, the debt is more bearable if you have lower interest rates or zero interest rates, but it doesn't go away. So whether it's government debt or large government-related organization or just simply too big to fail private organizations, it's not going to go away. So I think, yes, we will see more of the same in 2010, and we will have to be very careful and carefully treading water in various emerging markets. But I think the candidates are pretty much lined up.
I guess Eastern Europe has been, or certain economies in Eastern Europe have been risky for some time now. But how can investors protect themselves? I mean, I guess it's a classic risk and reward trade-off, isn't it? Where investors don't want to miss out on big possible upside, and yet don't get burned by situations like this. How can investors, do you think, best balance those two in this kind of climate?
Well, if there is a free lunch in financial investments, I think it bears the label diversification. And that's basically the only thing you can do, because you don't really know where it's going to blow up. You can expect some hiccups along the lines, and you could possibly have a large hiccup. And since we don't really know where, I think the only answer is to be everywhere and be well diversified and don't take big bets in any single country or any single currency.
And Mario, the thing that I want to ask you is, just a few days ago, Mark Moby was saying the Dubai situation could actually trigger the start of an emerging market correction. A lot of countries in the emerging market categories have come out and said, oh, no, our exposure or our links are pretty limited. But even if you take a look at India, 40% of population living in Dubai, working there, repatriating are Indians. And also, 30% GDP of Kerala, a southern state, comes from repatriation alone. So ultimately, when you think about this in perspective, the impact could be quite large, even for emerging markets, especially India.
Well, the impact is seemingly large at this point of time. In fact, the IMF chief has been said that, he made a point saying things like, okay, because of the problems in Dubai, there might be a problem right now in banks not even shoring up or being fully transparent in all their balance sheets. So if we're going to be looking at the emerging economies as a whole, I want to take it from a broader perspective. Broader perspective, what do I mean is that funds are still flowing into emerging markets, especially in Asia right now. If we're going to be looking at the low-yielding currencies of the US, even parts of Europe right now, people have no choice, or rather the hot money is still going to be flowing into many parts of Asia. That's going to be a big problem now. So it's going to be a tussle, a love-hate relationship really between the governments and the investors, because primarily governments in the Asian economies, they do want to shore up, or rather they want to fuel the GDP growth in their countries first. So while there's a lot of capital inflows coming in. We see Taiwan right now also having restrictions on capital inflows. There's going to be a tug of war between the governments of emerging economies trying to keep interest rates low, but at the same time trying to fend off, so to speak, currency restrictions that's coming in. So on a broader perspective, which is what I would like to add my comments on, is that we will still be seeing flows of money into Asia. It's just that the government's got to be wary at this point of time to help to spur up their GDP growth during these next few years.
Mario, leaving aside the emerging markets for a second and looking more broadly at what's going on, we have the ECB, for example, meeting this week, and people looking to the big global central banks to start giving indications of when they're going to withdraw some of the measures they've put in place since the credit crisis has begun. Do you think the fact that we are still seeing little flare-ups around the globe, like this situation in Dubai, will just delay word we may hear from the ECB, from the Fed, etc., about when they're ready to start withdrawing some of these measures?
Well, my opinion is that this whole week we're going to be seeing quite a lot of significant news that's going to be coming up. We have the PMI coming up, the Chicago PMI coming up. We have the non-farm payroll that's going to be up this Friday. But at the same time, my take on it is that for the U.S. government or for the ECBs, they are not going to be roiling the markets now as to be projecting whether they're going to be increasing interest rates. At this point of time, I just feel that most of their primary concerns has got to be what's happening in the nation itself. So while the U.S. is, they have to keep the interest rates low, primarily because of trade deficits or budget deficits. What's going to happen is that I don't feel the ECBs or even the Fed is going to be raising interest rates anytime soon at all.
And what's going to be dictating the way you look at currency moves? Is it going to be Dubai, or will it be that all-important jobs report?
Well, my take is that I feel that the Dubai was really a slight blip, if I may call it. A lot of people, although they were selling off, in fact, today, because the markets moved so fast, much of all those losses have already been paired. In fact, they're already up to pre-Thanksgiving level. So, in fact, you're looking at the euro dollar is close to 151 right now. It's already broken the resistance of 150. We're looking at the Aussie dollar is going to be probably heading up to about 95. It's at 92 right now. So, if I'm going to be looking at the whole Dubai story and my take on it, it was a small blip. It was great for investors to be coming in. You're
still expecting an RBA rate hike?
That's going to be happening tomorrow. Market sentiment is that it's going to be at 3.75. I feel that it is taking the market up over 200 pips because people are pricing in certain good expectations, but I don't think it's going to be a rate hike. I feel RBA is going to keep it constant at 3.5.
Of course, there is no RBA meeting in January, Becky.
Okay, gentlemen, thanks very much for joining us and running through some of the issues of the day. Mario Singh there, co-founder and CEO at FX1 Academy, and Baer Lenher, Chief Global Strategist at LGT Capital Management.